like our seminars to be interactive, of course, for you to learn as much possible. Who can tell me what is CPI and what's the difference between core CPI and CPI?
I know that CPI is a measure of inflation.
Yes, okay.
And
Someone else, what is the difference between core CPI and CPI? Guys, you're trading financial markets. You should know what are the basic economic information. And it's better for me to tell you that than that you lose all your money on trading stocks and forex markets. So
yeah, I don't want to be like parrot. So I mean, somebody else should say it. Somebody else should say it. Come on.
Don't worry. You can always say it. There are only five of us for now. So feel free always to interact. So I will say the differences and the introduction. So when we measure inflation, we think about it if you were an economist and if you wanted to see how the prices are faring out in the economy during the year, what would you do? You would, of course, go to the stores and look at the items that are mostly bought by consumers, right? Because that tells you how have the prices changed. So what do you would see what is the price of milk in 2021? What is it today? What was the price of milk last month versus what it is today? What was the price of bread? What was the price of car? What was the price of electricity? What was the price of oil, gasoline? And you would have a broad picture of what is it actually happening in the economy, with the prices, of course, in the economy. So, and that's CPI. CPI is a measure of inflation. Core CPI, as a difference between CPI and core CPI, is because core CPI excludes prices of oil and prices of foods. Now, why does it exclude? Because prices of oil and food are more volatile than other prices within the economy. And the reason being, you can see the Ukraine war with Russia. You had grain prices that had risen up. You had oil prices that had risen up. That's why usually Federal Reserve tracks core CPI more than CPI. So core CPI excludes food and energy. Now that for you personally, CPI is more important, but for Federal Reserve to track inflation, core CPI is more important, especially month over month, because they would like to see it falling month over month. So now that we know the difference between core CPI and CPI, yesterday, we had inflation news. We had inflation that was actually falling, right? From 4.9% the month previous to 4.0%. Core CPI was as expected on monthly basis. Then, if we were to look more deeply into what has happened within the economy, we can open what I sent Maras in chat, Bureau of Labor Statistics. This is economic institution that goes into more details and that publishes inflation data. So can you open the what I sent you?
Yes.
So can you scroll down a little bit? There is a chart now. Okay. Now, if economists want to do, just a second, give me a second, got my alert. Something is happening where I should enter a position. So when we look at what do we have here? We have food, energy services, all items less food and energy, commodities, services, and all the other stuff. So now, just give me a second. So now we have months, November, December, January 2023 up to May. And we can see what is happening from month to month on inflation basis. And what you now see, when you compare the last month to this month, you can see that actually what has fallen the most are energy prices, minus 3.6%. Okay, you can see that. You can see that food has actually risen 0.2%. Electricity has actually fallen. Gasoline has fallen the most. So the reason why CPI has fallen was actually the fall in prices for energy. And that's very important because that's actually something that we have been expected for a long time. And it has been happening for some time already. Also, commodities, less food and energy have still showed an increased tendency. You can see that they have risen 0.4% and they keep rising for the last few months. look at that. We need to see what will Powell tell us, because today we have FOMC meeting. So me as a macroeconomist, that tells me that the main reason that inflation has fallen is because energy prices have fallen. And that's important fact, because what the Powell and the team will look at, they will look at the table just like I have looked at it, and they will conclude what are they going to do. So I predict that what they will do, they will leave the rate hike as it is, meaning they will not increase the rate hike. It will stay, the interest rate will stay as it is, while they will have hawkish rhetoric, meaning they will say inflation is still above expectations. He will most likely even say that the main cause of falling inflation was actually the falling gas prices and oil prices. And he wants services to fall. Services have actually risen. He wants wages to fall. So we can conclude that the Federal Reserve still hasn't finished with its rate hikes, most likely. Nobody can tell you that for sure, but we can damn sure be pretty positive that he will continue with his hawkish tone. And that gives me another trade idea. That tells me that I will short gold from good resistance areas from 1968, 1985, if price comes to that point before the news. And as you already, if you have followed my trades, if you have already received, I like to be on break even before he comes out with his speech. But we can, I don't know, Mars, if you have time, we can even trade the FOMC live. So this was the CPI analysis and what I expect today for FOMC to happen. Regarding today's news, we have PPI. Who can tell me what is PPI?
It's a production price index. So basically, it changes of the prices that manufacturers have to pay.
Exactly. So what's the difference between CPI and PPI?
Well, CPI is what consumers are paying, and PPI is what producers are paying.
Well done. Exactly. That's true. So now that we know that PPI is a leading indicator, you can now understand why CPI is a lagging indicator, but PPI usually leads the economy, because if prices for producers have risen, if producers want to maintain their profit margins, we have talked about profit margins when we analyzed income statements, they will follow the prices, they will increase the prices up to the consumers, and consumers are going to pay more. So inflation will be first seen in PPI, and later it will be seen in CPI. So PPI was actually deflationary, meaning that you had an opportunity in a short-term time frame to go long on gold. But today, the most important thing will be FOMC economic projections, and we will see what they will tell us. I told you what I expect, what I would actually do. The only way I actually think is, I think of myself as being the governor of the central bank. What would I do? And you can already see why USA is USA, why UK is UK, because Powell is way better economist than Bailey or Christine Lagarde. And that's why this is how I'm going to go today. Of course, I will keep an eye watching what he's saying and what are the projections of the FOMC meeting. But this is my actually trading plan for today. Look at my last seminar. I said that even if inflation was falling, that could be bearish for gold, because if you have falling inflation, you have reduced fears and uncertainty in the market. If you have reduced fear and uncertainty, you could have gold falling. That's why the data could have been interpreted on both ways. That is the less likely option. The more likely option is that all at the beginning, everybody was like, and the news were also, CPI has fallen, go long on gold, and then they opened, just like we have opened now, Labor of Bureau Statistics, and then they saw that what actually has happened is that energy prices are the primary reason why inflation has fallen. And then they said, oh, that's not good, short gold. I think that the second option is more likely.
Okay, I have a question, Bart.
Sure.
Do you think maybe because from technical perspective, we have a strong resistance area at 1970, because price retest that, and then we have a huge sellers coming, and then that put the price down? Or you don't believe that's because of technical analysis?
That definitely could be. I mean, I'm always fundamentalist first, but that could also be. Here was an area of sellers, everybody was long, and then everybody looked at the labor. I mean, the smart people looked at the labor of the Statistics Bureau, and then they saw that the main reason why inflation has fallen was because of the energy prices. And then they told, oh shit, we have still high services. We have still, I think Medicare costs are also higher. If you can check it out later or now. And that's the reason why gold fell as well. But the thing about trading is when I'm looking at the fundamentals, I look at on the long-term time frame, but also when I intraday trade it, I look at the market sentiment, meaning I read the news and I guess the market sentiment. Like I told, you can always check what my predictions in the morning, what happened. I suggested longs on GJ, and the trade played out perfectly. Euro US dollar was suggested long. The trade also played out perfectly. GBP USD was suggested long. The trade also played out perfectly. So yeah, it is what it is. Nobody can tell you exactly what is going to happen, right? But we can use fundamentals to give us directions. But let's give it a counter argument. We have Germany in recession. We have Germany that is with high inflation, with increased interest rate hikes, and we have German index that is making higher highs while I'm shorting it. So fundamentally, this should go down, right? But it's following US 30 index, and it's really hard to explain it why. So as a fundamentalist, I could not explain you now why is German index going higher while it should go lower, right? Because economic data is telling you that DAX should fall. But it looks like it's copying what the US 30 is going. US 30 goes up, DAX goes up. So, and I opened the short position on all-time high now. Yeah, the only reason I could say that is that forward PE is below what is expected, is below market average. But yeah, I can't explain it on DAX. I really can't. Unemployment rising, I believe, production falling down, inflation high, risks of stagflation, and index goes up. This is, for example, one thing I could not explain with fundamental knowledge, right? I suggest watching the film by Michael Burry, was the main investor, The Big Short.
Big Short, yeah.
Yeah, he was short on the on
Houses.
their housing market, and he was waiting 2 years for his trade to play out. Yeah. Right? He was short. He had margin calls, and he was so sure in his short, right? So fundamentals, in the end, fundamentals always defeat. But will you stay solvent up until that time, right?
Okay,
so,
okay. When let's say you enter now in the US, in the German 40 short, and when you got margin call, then tell us and we can short.
right. So, but I have my stop loss, so I don't think I'll get the margin call. That's the only reason I would expect testing of the 2000 area. In the long run, if we continue to have decreasing inflation and strong US market, we will see gold in 1600s, because there will be no reason for gold to stay. But we always have to think about, if you are some other hedge fund manager, if you were head of the JP Morgan, if you were head of the central banks, what would you do, right? But to think about it, you have to know economy. You have to understand what is macroeconomics, how does it work. Why would you have gold? Let's say this: if US stock market does not go into recession in the following 3 months, why would you buy gold? If you can buy stock market, gold doesn't yield you anything. Gold doesn't have a value. Gold has a price. But if you bought Apple, if you bought, I don't know, some other stock, McDonald's, Boeing, the last two are really bad examples, because their balance sheets are really bad. But you would rather buy stocks because you would get dividends, because you would expect stock market to go up, and you would sell gold. And thus, this is the reason gold should fall down. Okay?
Okay. According to what you say right now, then we could wait for a potential sell opportunity in the long term, maybe 1985 or even 2000 area, something like that.
Yes.
Okay.
Yes.
Okay. But in the short term, price could go higher.
In the short term, price could reach higher. Yeah, depending on the fundamentals.
So 1985, 2000 area will be mine next sell zones. So yeah, okay. Now, do you have any question about gold?
Feel free to ask. You're always here to learn anything you want to know about.
Okay, if not, then we can switch to GJ, who's making how?
Yeah, I have a question regarding gold. So if you said that, why would they invest in gold if they can invest in stocks? Why do you think that this price might go to 1985? I didn't get that part.
Because we can have short-term movement, right? So if we look at the price on the longer time frames, price movements from 1940 to 1985 isn't that significant on the weekly or monthly time frame. But when you look at the intraday, if you're a day trader, you would more likely follow the most recent fundamental data and the most recent market sentiment, meaning news. And that's why you could see some kind of a gold dancing around. So when we talk about big fundamentals, like for example, when I said I expect gold to fall to 1600s, it would be more precise to look at it on weekly and monthly timeframes, right? Because I'm predicting what gold will do in the next 3 to 6 months, right? Not what it will do in the next 2 to 3 days. If we are talking about 2 to 3 days, we are talking about prices from 1940s to 1980s. But if we are talking about 2 to 3 months, we are talking about way bigger prices, and we are not looking at $20 or $40 movement in the price.
So if the Fed make a pause now, what do you think that, like, what would be the reaction on gold? Do you think it will like stay in the range, or?
After the news come out, but I believe at 8 p.m., the gold will not move because the market participants have already priced in. Do you know what priced in means?
Yeah, it means that it like already happened, like the market already expected the news, and then, you know, it already acts accordingly to the news that's going to happen.
True. Yes. A lot of people who trade actually don't know what pricing in means. So yeah, that's really important to understand. That's correct. So I don't expect specific gold movement if he does not increase rate hikes. What will be most important will be his speech 30 minutes later, where he will give his projections of the market. And that's what I said. Why is it important when I'm thinking about thinking like a central banker? What I would do, I would remain hawkish, but also I would say for now, we do not have any rate hikes. We will continue to monitor the data. That's actually what I would say if I was on Powell's position. Now, what does it give me? It tells me nothing specifically. It tells me that there is high possibility that US 30 is going to break up, while gold is going to probably continue down. Okay, that's what I believe. So my plan will be shorting before his interview. If we reach my price, I think it was 1980 something or 1970 something. 1980. Yeah, even 1970 is okay. But if he comes out and says, we see that inflation has fallen down, we are stopping with our rate hikes, we believe that prices are falling down and will continue to fall down, that tells you he expects weaker dollar in the future. And this will be a trade for shorting the dollar, meaning going long on gold, going long on US 30, going long on GBP US dollar, Euro US dollar. But you could have, if you watched my analysis in the morning, the picture I posted, you could have already had entries in these positions longs, and your stop loss is on break even. Was I clear?
Yeah. I also just want to give one comment on CPI yesterday on the details. You can see over there that like used vehicles rose like 4-point-something%, and
You have it open, Maras.
New vehicles actually went down. So they actually think that that's where like used vehicles have to go down. But I mean, they have like a slower, they do not follow up with new car prices. So
used cars actually went up.
Yeah, and that's where they can go a bit down.
Yeah, that's true. Medical services went up. That's the problem, because if you watched ISM for services, he was like, he wants it to go down. Yeah, all service, less energy services, shelter went up, transportation services went up. So in the end, he will most likely remain hawkish. If he doesn't remain hawkish, I will question his economic knowledge, but I think he will stay hawkish. Because why would you give market participants opportunity to go even higher when you have economic conditions with increased rate hikes? Usually, when central bank raises interest rates, the real economy, the market, is affected at the same time, because market participants are pricing in what will happen in the future today. But markets will be affected between 6 months to 2 years. Do you know why is that? If, for example, Powell comes now and says, I will raise interest rates for 1 point, the economy, the results of that in the economy will be seen, let's say, in around 6 months to 1 year, but the market will react automatically. Do you know why there is a lag of 6 months to 1 year? Some books say even 2 years.
Well, I guess it takes time for economy to react for what's going on.
It takes time. Now, why does it take time? Now, think about it this way. If we look at the bank's balance sheet, let's say Bank of America, which is a lender, or the regional banks, which lend money to us, right? To consumers, to to companies that like to build new projects. The ones that actually have already gotten that credit, they usually have fixed interest rate, meaning even though Powell has now increased his interest rate, they still have the same mortgage and they still have the same credit. But the ones that are yet to go to demand a new credit from the bank, they will have higher interest rate. And that's why there is a lag, because the current economic situation is that market participants have an interest rate of, let's say, 5%. But all participants that want to get credit after the raise, let's say week from now, month from now, 2 months from now, they will have 6% interest rate. And that's the reason why there is a lag, because those that have 5% interest rate might pay it out in 1 year and then get a new credit for 6%. That's why there is a lag of the monetary policy in the economy. And that's why when you raise interest rates now for 1%, the effect on inflation will be seen in 6 months to 1 year.
Okay. Should we now go to the GJ, or?
Yeah, we can go GJ.
Or it's probably the same like the last couple meetings.
Yeah. So, Wisdom, are you here? Are you listening to the?
Yeah, I'm here actually. I just didn't know a lot of the stuff, so I didn't really have any questions to ask. It's just learning right now for me. So,
do I have to repeat? Do you already know why GJ is going up?
I would like if you could repeat that, please.
No problem. So when we look at the economy, for now we are looking the inflation rates of the United Kingdom and the inflation of Japan. This is our current theme, okay? And what we actually had news yesterday and today from United Kingdom that were actually pro-inflationary. And pro-inflationary means that, let me take a step back. Can I, Maras, take your remote control?
Yeah, of course. But I think something's wrong with your mic.
Is it really? Can everybody hear me?
I mean, now I can hear you, but a couple of minutes ago it was like every other word I can hear.
I don't know. Maybe the internet. Sometimes I think the internet is not the best in the house I live in, because sometimes it actually breaks me off, and then I do everything on my mobile phone. Connect my mobile phone to the laptop. Okay, so when we look at the economies, first we will do Wisdom. We will do macroeconomic analysis. Okay, macro view. Now, when we look at macroeconomic view, we need to analyze United Kingdom's economy and Japan, okay? And when you analyze economies, what you are most interested in is GDP, unemployment, even though employment is very important, and inflation, okay? And the theme now, as you have seen, the theme all around the world this year and last year is inflation. And then you look at inflation in Japan, right? I think it's around 3%. Inflation, meaning CPI, inflation meaning CPI in the United Kingdom is around 8%. So now you know that usually inflation is fought by monetary policy, okay? Meaning interest rates. So that tells me that United Kingdom has to have higher interest rates than Japan, their central bank. Just like today's FOMC meeting, they have to keep raising their interest rates. The higher the interest rate of one country, of their central bank, the stronger the currency. Because think about it, why would you invest your money in Japan bond or Japanese market and get 1% when you can invest it in the United Kingdom and get 4 or 5%? So that's the reason GBP is stronger than Japanese yen, and that's we are fundamentally bullish. And if you were in this group for the last 3 months, I think Sonia is for the last 2 months, you know that we are actually calling longs on GJ the whole time because fundamentals are bullish. And then when fundamentals are bullish, we just search our technical analysis, where could we find best long entries? And this is the reason why GJ is bullish. You need to understand the monetary policies and inflation of these two countries. So from now on, GJ, we are still looking for longs. Will we have retracement? Nobody can tell you that, up to which price, where the price is going to go in the short term, but we know we are looking for longs. On the 30-minute time frame, today you had a good range. I bought at the low of the range, and I took around 70 pips. My stop loss was 20 pips. Can you open 30-minute, Maras, please? Yeah, that was a good range down here. Yeah, this was the resistance. I actually had resistance up, but at the bottom of the range, this was my longs. 176, 600 was my longs, somewhere around there. Yeah, this is my trade. I didn't send it to the VIP group because I was out, but yeah, this was the trade. So when I know I'm looking for longs, I find good risk to reward opportunities to enter into my direction. Okay. For you to better understand, it is not just enough to look to come to the seminars. I will repeat something 50 times so you can learn it more easily. But read the news, look at YouTube videos about monetary policy, watch Bloomberg Live, read books. Right? This will all give you fundamental data and information that will help you to learn better. And then when you come to my seminar, you will only expand your knowledge way bigger.
Completely agree. I'm actually going through like I'm actually learning some economic terms now with like after I came for the last Zoom we had here when you explained the interest rates and the 3 core principles for an economy. I think that's when you showed the GDP, unemployment rate, and also inflation. So I've actually started studying some things, and some of these terms are new to me. But yeah, completely agree with what you said.
Don't worry, with time and with this group, you will learn everything. Are there any other questions?
No, none for now for me.
Okay, if we don't have any questions, yeah, I have another meeting, so I will have to go. We will also have this week one more Zoom meeting, so prepare your question for the next time and feel free to ask the question, Bart or me, doesn't matter. But don't ask me about fundamental analysis because Bart knows. And yeah, that's it. So thank you guys for being here. See you tomorrow in London session again. So thank you and bye-bye.
Thank you guys. Goodbye. Take care.
Bye-bye.
Thank you.